What are trading patterns? Why are they created? And how can we trade using them?
Hello, and welcome to the Tradiology channel.
We will talk about trading patterns, why they are formed, and how we can enter trades using them. Also, we will go to TradingView and practically learn about the best trading patterns and how to take positions using them. Trading patterns are areas where price is mostly compressed, and often after breaking this compression, the market finds a direction. If we can identify the breakout direction with the knowledge we gain, we can have profitable trades. First question: why are trading patterns formed? Financial markets generally, instead of moving directly and quickly, first make a strong or relatively strong move, and then enter a rest phase to decide whether they will continue the movement or reverse it. This rest phase often forms a pattern. Well, how many types of patterns are there? Patterns are either 1. Trend continuation pattern. 2. Reversal patterns. We will review each of them on the chart together. Continuation patterns have various names, with the most famous being flag pattern, which includes the triangle pattern, falling wedge in an uptrend, and rising wedge in a downtrend. Double bottom in an uptrend, double top in a downtrend. Reversal patterns include rising wedge in an uptrend, falling wedge in a downtrend, double top in an uptrend, double bottom in a downtrend. The most famous, head and shoulders pattern, also known as MTR, major trend reversal. Let's find these patterns on the chart. To find continuation patterns, the first step is to look for a strong trend like this one. Then, in areas where you see prices correcting and pulling back, try to connect the highs and lows of this correction. What is this pattern? It's a falling wedge in an uptrend. Since we know that 75% of the time, this is a trend continuation pattern, we can enter a buy trade upon its breakout. This candle is where you can enter a buy trade, and you can set your stop loss below the breakout candle or below the pattern, depending on your risk tolerance. Here, we also see the bearish version of this pattern. By connecting the highs and lows, the pattern becomes clear, and you can enter a trade upon the breakout. The next pattern is the triangle pattern. First, find a strong trend. In the corrections, by connecting the highs and lows, the pattern is formed. Difference between triangle and wedge. In an uptrend, the triangle pattern forms lower highs and higher lows, while the falling wedge forms lower highs and lower lows. So, be very careful not to get confused. Here's an example of a triangle pattern in a downtrend, which caused a sharp drop after the breakout. Triangles are extremely profitable patterns, so practice them a lot. However, remember, these patterns are not 100% accurate, and they don't always lead to profits. Therefore, risk management and backtesting are crucial. The next pattern is the double bottom in an uptrend. First, find a strong trend, then if you see a formation like this, you can enter a trade on the second bottom using an engulfing pattern. This section also shows a bearish version of this pattern, where you can enter a trade on a good candle at the second top. Now let's move to reversal patterns. If you're new to financial markets, I recommend not trading breakouts of these patterns, because most of the time, the trend continues in its original direction. However, when these patterns succeed, they offer big rewards and ultimately lead to profits. But at first, stick to trading continuation patterns, as reversal patterns are better suited for experienced traders. It's great to learn them, but avoid trading them initially. The first pattern is the rising wedge in an uptrend. In an uptrend, higher highs and higher lows form, but they lack strength, resulting in this pattern. Upon the breakout, we can enter a trade. In this example, during a downtrend, by connecting highs and lows, we see a falling wedge in a downtrend, which is a reversal pattern. It likely signals the end of the downtrend. The next pattern is the double top in an uptrend, like this one. In an uptrend, first, a peak forms, then the price pulls back. When it reaches the previous peak again, an engulfing pattern forms, indicating that the trend might end, and we can enter a trade in the opposite direction. In this example, we also have the inverse version of the previous pattern, the double bottom in a downtrend, where with a good candle, we can enter a buy trade. The next reversal pattern is the head and shoulders, which is a stronger reversal pattern than the previous ones. In this pattern, during an uptrend, the price breaks below the previous low, and upon reaching the previous shoulder, we can enter a sell trade. We also see the inverse head and shoulders, where upon reaching the previous shoulder, we can enter a buy trade. The most popular trading pattern, which I personally use frequently and has a high success rate in counter-trend trades, is the MTR, Major Trend Reversal. In this pattern, we draw a gently sloped trend line, and when the price breaks and pulls back, we enter a counter-trend trade. Initially, there's a downtrend, and after breaking this trend line, we can enter a trade on the pullback. Here's another example of this strong pattern, where we enter a sell trade on the pullback. Key tip: in MTR patterns, avoid drawing steep trend lines. Practice these patterns every day. If it's hard to draw them, re-watch this video. When you find your favorite pattern, backtest it, analyze its success rate, and then enter trades confidently and enjoy trading. Thank you for watching this video. Please subscribe to my channel, like this video, and leave your comments below so I can guide you further. Wishing you success.